Have you ever wondered, if money shifts to completely digital, can Islamic finance still stay true to its principles? Across the world, more than 100 countries are testing or developing central bank digital currencies, also called CBDCs. Some are already in use. China has the e-yuan, Nigeria has the e-naira, and many Islamic countries are exploring their own digital money. But here's the big question. Are CBDCs halal? Or could they become another tool for riba and state control? Let's break it down. What are CBDCs? CBDCs are not the same as Bitcoin. They are not private cryptocurrencies. And they are not stablecoins issued by companies. CBDCs are official digital money, issued directly by a country's central bank. In simple words, it's the same as cash, but it exists only in digital form. You can store it on your phone. You can send it instantly to someone else. And the government can track every single transaction. Unlike Bitcoin, which is decentralized, CBDCs are centralized. The state is in full control. Why are governments pushing CBDCs? Governments see CBDCs as the future of money. Why? First, efficiency. No printing costs, no physical cash to transport. Second, financial inclusion. Billions of people in developing countries still don't have a bank account. With CBDCs, all you need is a smartphone. Third, faster payments. Imagine instant cross-border transfers without expensive fees. Fourth, security. Governments can fight money laundering, tax evasion, and terrorism financing. But, of course, more control always comes with more questions. Central banks in Islamic countries. Now, let's pause for a reality check. Do all Islamic countries have central banks? Yes, every single one. However, are these central banks themselves Islamic? Not really. Most Muslim countries use a dual system. Conventional banks operate side by side with Islamic banks. The central bank controls both. Only two countries, Sudan and Iran, run fully Islamic systems. Every bank, every product, must be Sharia compliant. But in places like Malaysia, Saudi Arabia, Turkey, or Indonesia, Islamic banks are just part of a larger system. This creates a paradox. Islamic banks avoid riba, but the central bank still sets interest rates as part of monetary policy. So when a central bank issues a CBDC, we have to ask, will the digital money carry the DNA of riba, or can it remain neutral? CBDCs versus Islamic finance principles. 1. Riba. The biggest question is interest. A CBDC itself is just digital cash. It doesn't automatically create riba. But if a CBDC is linked to interest-bearing accounts, or if it's used to enforce policies that depend on interest rates, the risk of riba is real. 2. Gharar and Maisar. Cryptocurrencies are often criticized in Islamic finance for being speculative. CBDCs are different. They are backed by governments. They have stable value. So the risk of uncertainty and gambling is much lower. 3. Zakat. This is where CBDCs could be powerful. Digital money makes it easier to calculate wealth. It could even allow automatic zakat deductions. Imagine a system where every Muslim's obligation is fulfilled seamlessly. 4. Privacy and ethics. In Islam, trust and dignity matter. CBDCs allow the state to monitor every transaction. This raises ethical questions. Too much surveillance may conflict with individual freedom and privacy. Opportunities for Islamic finance. Let's imagine the positive side. What can CBDCs do for Islamic finance? Smart contracts. CBDCs could enable digital contracts that are Sharia compliant. Zakat, Waqf donations, or Islamic insurance could be automated. Transparent sukuk markets. Right now, issuing and settling sukuk is slow and costly. CBDCs could make the process instant and cheaper. Financial inclusion. Many Muslims in Africa and Asia don't use banks. With CBDCs, all they need is a phone. This could bring millions into the Islamic financial system. Standardization. One of the biggest challenges in Islamic finance is inconsistency. Different scholars, different countries, different rulings. CBDCs could offer a platform where Sharia compliance is digitally programmed. In theory, CBDCs could make Islamic finance stronger, faster, and more transparent. Risks and challenges. But the story is not all positive. CBDCs bring serious risks too. Surveillance. With every transaction visible, the state gains unprecedented power. This can clash with the Islamic principle of privacy. Riba through monetary policy. Even if CBDCs are neutral, central banks still use interest rates to control the economy. This underlying structure could drag CBDCs into the riba framework. Dependence on foreign technology. If Islamic countries rely on Western or Chinese tech to run CBDCs, will the system truly be independent, or will it create new vulnerabilities? Sharia oversight. Who will guarantee that CBDC systems follow Islamic principles? Will central banks set up Sharia boards? Or will Islamic finance once again play catch-up? Case studies. Let's look at some examples. Nigeria, Naira. Launched in 2021. Nigeria has a large Muslim population, but so far, adoption has been slow. Saudi Arabia and UAE, Project Aber. A joint digital currency experiment between two central banks. Its goal is to make cross-border payments easier. This could become a model for the Gulf region. Turkey. The Central Bank of Turkey has already tested a digital lira, with a growing Islamic banking sector. The question is whether this CBDC will integrate Sharia-compliant features. There is also an interesting detail about Turkey's central bank. Its name is not Central Bank of the Republic of Turkey. Instead, it is Central Bank of Turkey. Why is that important? Because the wording was chosen to highlight independence. It means the bank is tied to the republic itself, not directly to the government of the day. In other words, the name signals that the central bank serves the nation, not just whoever is in power. Indonesia, the world's largest Muslim population. Indonesia is studying a digital rupiah. It has strong Islamic finance institutions, so expectations are high for Sharia integration. These case studies show that CBDCs are not just theory. They are coming fast. The central bank's paradox. Now we return to the paradox. Central banks in Islamic countries are not Islamic institutions. They are modern institutions that rely on interest-based policies. Islamic finance works inside their framework, but it does not control it. If CBDCs are simply a digital copy of fiat money, they will carry the same interest-based DNA. If they are redesigned with Islamic finance in mind, they could become a game changer. So the future depends on choices made today. Will Muslim nations design CBDCs that reflect Sharia principles, or will they simply copy Western models? Central bank digital currencies are not science fiction. They are already here. For Islamic finance, they bring both hope and danger. Hope, because CBDCs can enable transparency, financial inclusion, and easier zakat. Danger, because they can deepen the influence of riba and state surveillance. The truth is, CBDCs are just a tool. Like any tool, their impact depends on how they are designed and how they are used. So I leave you with this question. Will CBDCs strengthen Islamic finance, or will they quietly undermine it? What do you think? Is digital money the future of halal finance, or a Trojan horse for riba? The real rival will appear between decentralized currencies and centralized ones in the future. Digitalization, unavoidable trend of modern life. However, what about the being fully transparent and accountable? The real challenge will be lived based on this zone. If you found this video useful, don't forget to like, share, and subscribe. Leave your thoughts in the comments below, because the future of money is too important to ignore.